Mohyuddin Azim, in his article for Dawn's Business and Finance Weekly, explores the quest for value-added exports. Azim notes that within the last fiscal year, Pakistan's exports were $31.1 billion, while imports reached $53.2 billion, resulting in a $22.1 billion trade deficit. This deficit is smaller than the previous year's $24.8 billion. The country's external financial situation is still precarious. To close the external financing gap, which is expected to remain around $20 billion, Pakistan needs to significantly increase its export earnings. Cutting back on imports isn't a viable option anymore, as doing so would hinder the country's targeted 3.5% economic growth rate for this year. Plus, the IMF, under its new $7 billion support program, has advised against further import restrictions. Instead, the IMF has urged Pakistan to develop an export strategy focused on product diversification and value addition. In the last 2 fiscal years, Pakistan managed to keep imports low, with $53.1 billion in 2024 fiscal year and $52.7 billion in 2023 fiscal year, mainly through strict tariff and non-tariff measures. However, the IMF had suggested relaxing these import restrictions, considering the forex crisis the country faced. The State Bank of Pakistan's reserves had plummeted from $9.8 billion to $4.4 billion. Only recovering to about $9.4 billion with financial support from China, the UAE, and Saudi Arabia, as well as a short-term $1.3 billion IMF loan. Currently, the reserves stand at $9.03 billion, covering roughly 2 months of imports. Boosting exports is now crucial, but this requires product diversification, more value addition, and exploring new markets. However, implementing these strategies is challenging due to the current political instability, economic difficulties, and an ongoing energy crisis. High production costs and soaring energy prices are squeezing businesses, and there's growing resistance to paying more for energy. Expanding into existing export markets like Afghanistan, China, Bangladesh, the US, Europe, and the GCC is also challenging. Relations with Afghanistan are tense, and Bangladesh is experiencing domestic political turmoil. Additionally, unpredictable relations with the West make it tough to maintain market access. Meeting the high standards of US and European buyers while staying price competitive is increasingly difficult, especially as energy bills, wages, and production costs rise. Simply lowering interest rates won't solve these issues. However, there's potential for growth in exports to China and the GCC region. China's steady demand, coupled with the second phase of the China-Pakistan Economic Corridor, offers opportunities. The GCC region also holds promise, given Pakistan's strong ties with Saudi Arabia and the UAE and the significant population of overseas Pakistanis in these countries.